look, in a sense, we've seen a lot of activity, in the E-mini S&P 500 from the beginning of the cash open. So do note these open drives are very much a cash open strategy. As the name suggests, it's an open drive, so it's the open of the most liquid time of the day. And in essence, what we're looking at is when we have these open drives, they do have a very unique, specific approach in order to, that you have to adopt in order to make money. So that's what we're going to talk about today. Now, where we're going to start off with this is actually just discussing, the principles around an open drive and how it ultimately works. And I always find the best way to start this off is to just illustrate it for the viewers so that you get an understanding of what the open drive is. Okay, so like I said, first thing, right, it's initiative taken on the open. Okay, so this exists in any market. It doesn't have to be the equities. It can be the bond markets. It can be, the orange juice futures, whatever it might be. But what in essence happens is you've got to think of this in terms of participants. Now, because the cash open is the time of the day where liquidity is at the highest. In other words, there's the maximum amount of liquidity possible. All right. Sometimes what happens is participants on the open need to execute relatively large orders. Okay. Now think about it logically. If you have a large order to execute and you're a broker, would you prefer to do it at lunchtime when everyone's away and there's no liquidity in the market, or would you prefer to do it when everyone's in the market and everyone's looking for fills? Okay, so what in essence happens is you've got these large orders that come to the market on the open and they need executing. Okay, now one of two things happens. When those large orders come, the market will start at a various price point, okay, and it will open drive. So it'll go straight bid up and it'll continue to sort of bid up until that order is filled. Once it finds some sort of liquidity, we'll call this X area the liquidity. Once it finds that liquidity, you'll see the market back off a little bit. Okay, so we'll have a little bit of a pullback, more a consolidation phase before then the market resumes the price trend. Okay, now that resumption of price trend and continuation is all dependent on the amount of the order. Okay, so the larger the order, the more likely we're going to continue in that direction. All right. Also, the more participants looking to partake in this open drive, the more likely we are going to continue. The less liquidity available, the larger the increment of prices we're going to trade over. Okay, so there's a number of factors you have to consider in terms of how much and how far, but ultimately the opportunity or the bias when there is an open drive is for price to move in one direction. Okay, and that's the key takeaway. Remember, no one can teach the exact execution methodology. It's about understanding the principles that govern the direction of price, knowing when you want to be going with price or going against it, and ultimately how you can take advantage of it. So that's in essence what we're looking at. We're looking at a large order which ultimately relates to a large move in price. Okay, now it's not always a case of if there's a large order, price is going to move aggressively. Sometimes you do get a large order coming into market and someone matches it. Okay, that does happen very infrequently, okay, but it does tend to happen. Okay, so what we're looking for is a large order, and we denote that large order with volume. Okay, so we're looking for that large order, but we're also looking for the accompanied large move in price, because that tells us that this large order is actually, going in search of that liquidity to try and get filled. Okay, now this is the most important question to ask: is this move ultimately sustainable? Okay, now when there's large orders in the market, it's not just simply a case of the buyer comes in and buys for 5 minutes and stops and disappears. Okay, this is very much a sustained move. Very often it's going to sustain itself for the entire session. Okay, so that you can kind of get the understanding why this is such a powerful strategy that a lot of the traders look at. It's simply because it gives us a sustained bias for the entire day. Right? If you know that there's a high probability that price is ultimately going to keep going up all day, right, that gives you a very good understanding of some of the opportunities that exist when we have such a thing like an open drive. Okay, now what we've in essence seen, over the last two sessions, and I'm just going to illustrate it on the next slide. We've actually seen what they call an open test drive. Exact same concept, exact same initiative, except in this instance what happens is the market opens. Okay, it first goes in sort of bid up effectively, and it's testing higher prices, and once it finds that sell order then initiates and drives. Okay, so sometimes what actually happens is you don't get those large orders coming into the market right on the 230. Okay, sometimes you actually get the market, going the opposite direction. In other words, there is a seller at the open. Okay, there is a large order that needs to be filled. He is selling it, but ultimately someone is bigger and willing to buy it off of him. Okay, in this instance, what happens is the market goes bid up. Okay, it's a lot of liquidity, a lot of volume. Ultimately, that buy order is finished, and as soon as that buy order is finished, we see the drive. Okay, and that's what we're going to look at. We're going to look at two examples of this open test drive and see what it looks like. The premise of it, the strategy opportunity is one and the same. Okay, the manner in which you execute an open drive or an open test drive is one and the same. Okay, now the most important thing to understand is in terms of where we're falling on the lagging leading information spectrum. Okay, what you have to bear in mind is that you do need to wait for a certain amount of information. Right, like I said to you, the key sort of variable we're looking at is volume. Okay, so we need volume and we need a change in price. All right, if we get these two variables ultimately, we then get the potential for an open drive or an open test drive. Okay, without those two, we've got nothing. Now, because we have to wait for this means we are lagging. We're taking lagging information in order to make a sort of forward-looking decision on price. Okay, so yes, we are foregoing the initial opportunity. We are foregoing, this sort of slice of the pie. Okay, but by foregoing the slice of the pie, what happens is we take the probability of outcome from, say, 0.2% to 0.8%. Okay, in other words, by simply giving up information, okay, you are allowing or you are moving the odds of a continued move very much in your favor. Okay, and that's important to understand because a lot of the time we want to be aggressive and make the assumption that we have an open drive and we execute up here, and the next thing the market goes and stops us out. Okay, so we wait for enough information that triggers confirmed price response and volume that an open drive is in play. Then we can execute. Yes, our win is smaller, but we can execute with more confidence, which means we can employ leverage. Okay. This is ultimately an opportunity, but it requires a little bit more patience. You have to be patient, let the market confirm that you've seen the open drive or the open test drive, and then, execute. Now, again, why this is so much more powerful than preempting or being presumptuous is that the moment you know that the open drive's in, based on the metrics, not based on what I'm saying, based on the metrics, you can then define your risk. Okay, in other words, if you know that the open drive is in, the risk is very easy to manage, and I'll show you where that risk goes in a second, but it's very, very easy to define your risk. Okay, so what have we got here? We've got a high leverage trade, we're waiting for specific variables, we know precisely what our risk is, and we have exposure to a high probability opportunity. Okay, in essence, what you've got is the holy grail of a strategy. Okay, it's got all the metrics we need: probability, understood risk, potential for leverage, and very high probability for opportunity. Okay. Let's now move on to it. Let's get into the example that we want to talk about this week, and it comes from the S&P from Friday the 22nd. Okay, so the 22nd of March. This is the example from last week, and ultimately what we're going to look at is the footprint chart. Now I'm going to illustrate this actually first on a candlestick chart so it can make sense to you. Okay, green line is the open of the cash session, and these are 5-minute candlesticks for you. Okay, so what we can see: market opens, bid up. Okay, note the volume. Right, substantially higher than the average, so very, very high volume going into the open. Okay, now we know it's high because if we compare the volume at the open to the close from the previous session, that's this bar here, we can see it's almost the same amount of volume. Okay, so on the open we've got a very, very big surge in volume, almost the same amount as the close from the previous session. Okay, market then sort of holds a bid initially. We can see a little bit of selling coming off the top, inside candle. Right, and then notice what happens to the volume. Okay, so we have the open, we have the test. We test this area, this price point called 2850, and suddenly the seller steps in. Okay, so what's happened is there's been a buyer at the open. He's lifting very big offers, and we'll see this in the footprint in a minute. So he's lifting the seller. The seller doesn't, the seller's obviously selling at the same time, so we have two-way trade. Eventually the buy order is finished, and the market plunges. Okay, now to put this into perspective, the move is 51 all the way down to 30, so we're looking at a 22 handle move. Okay, now that should be significant for most of you because that's roughly speaking about 1%. Now, what we're looking to do is, in essence, we're looking to actually try and capture, if we can, some part of this. But this is the meat of the move. Okay, so an open drive, like I said to you, there's a high probability it continues in the direction of the drive. Right? So in essence, the big opportunity is the pullback. All right, we're looking to get engaged on the pullback and take advantage of leg number 2. And we can see leg number 2 is actually a 40 handle move relative to the 20 handle move we saw in leg number 1. So yes, we forego opportunity, but it gives us more information, which you can see in terms of volume, we can see in terms of price change, in order to take advantage of the 35-40 handle move. Okay, now I want to show you this again because we had the exact same thing yesterday. Before I move on to the footprint, we had the exact same thing yesterday, which was the 25th of March. Okay, so again, notice the volume. Okay, volume almost exactly the same as the last 5-minute candle on the cash open on Friday. Market opens, drives up very aggressively, so very, very high volume. Again, what do we see? Order filled, and suddenly the market drops all the way from 12s down to 89s. Again, another 24 handle move. Okay. This time, however, notice what we did. Market tried to pull back. Okay, so similar pattern, tries to pull back. We try and enter our shorts. Okay, market puts us inside, but then the market stops us out and continues in the opposite direction. Okay, so the moment it stops that out, the moment it gets back above that pullback point, okay, that's effectively where your risk is. That's where the game's up. Okay, so it's simple as, once we get that pullback, we're entering our shorts 2800s. We've got a nice tidy stop 2802s costing us 8 ticks. We're looking for extension and continuation on 2790. So we've got a decent, even if you just play for a retest of the lows, you've got a decent 10 handle move for a 2 handle stop. Okay, simply utilizing the information that we have at hand. Okay, and as we can see, obviously the market does go a bit up. It takes a few of the shorts out of the market, and for the rest of the day we just went sideways. Okay, so we still have an open test drive, right, but we have no continuation in this example. Example number 1, we get exposure to 40 handles. Example number 2, we have exposure to 10 handles, but we end up getting stopped for 2 handles. Okay, and that's the key crux of it. It's not a case of it's always going to pay out. It's not a case of, it's a foolproof strategy that always works. It's a case of, what are the metrics? How much are you going to lose when it gets wrong? How much are you going to make when it gets right? Can I match the numbers? When I get it right, I'm making 10. When I'm getting it wrong, I'm making 2. It's working 4 times out of 5. Therefore, in the long run, if I do it 10 times, I'm making money. That's the crux of it, guys. That's how this game works. Okay, so let's look what it looks like on the footprint.